In 2026, a question is quietly circulating among top investors, hedge fund managers, and everyday traders alike. Is Wall Street entering what some are calling a lost decade? It sounds dramatic, but the data, the shifting strategies, and the tone of the market all suggest something deeper may be happening beneath the surface. This isn't about a sudden crash or a headline-grabbing collapse. It's about something more subtle and potentially more dangerous: long-term stagnation. To understand this, we need to take a step back. A lost decade doesn't mean markets go down every year. It means that over a long period, sometimes 10 years or more, returns are flat or disappointingly low when adjusted for inflation. We've seen this before. After the dot-com bubble burst in the early 2000s, the S&P 500 took years to fully recover. And now, some analysts believe we could be entering a similar phase, driven by a completely different set of forces. So what's changed? First, interest rates. For over a decade, markets were fueled by cheap money. Low interest rates made borrowing easy, encouraged risk-taking, and pushed stock valuations higher. But now, central banks in the US, UK, and Canada have shifted gears. Rates are higher, and more importantly, they're expected to stay higher for longer. This fundamentally changes how investors value companies and where they put their money. At the same time, inflation has reshaped expectations. Even if markets grow, real returns, the gains you feel after accounting for rising costs may be much smaller. This is one of the key reasons why some experts are warning about a lost decade. It's not that the market won't move, it's that it may not move fast enough to outpace inflation in a meaningful way. Another major factor is valuation. After years of strong gains, many sectors, especially technology, are still priced at relatively high levels compared to historical averages. That doesn't mean they'll crash, but it does mean future growth may already be priced in. In other words, the easy gains could already be behind us. Now here's where things get interesting. While the average investor may still be thinking in terms of buy and hold, many high-level investors are quietly changing their playbook. They're not necessarily abandoning stocks, but they are becoming far more selective, more global, and more strategic in how they allocate capital. One of the biggest shifts we're seeing is a move toward diversification, not just across sectors, but across geographies. Instead of focusing only on U.S. markets, investors are increasingly looking at opportunities in the UK, Canada, and even emerging markets. The idea is simple. If one region underperforms, another might outperform, helping to balance overall returns. We're also seeing a renewed interest in income-generating assets. In a low-growth environment, dividends and cash flow become far more important. Investors are paying closer attention to companies that can consistently return money to shareholders. Another strategy gaining traction is what some call active patience. Instead of constantly trading or chasing trends, investors are waiting, holding cash, watching for opportunities, and being ready to act when valuations become more attractive. At the same time, technology is still playing a critical role, but with a different lens. Rather than investing broadly in tech, investors are focusing on companies with clear profitability, strong balance sheets, and real-world applications. So while the idea of a lost decade might sound alarming, it doesn't have to be a negative story. For some, it could be the beginning of a smarter, more resilient way to invest, one that's built not just for growth,